Thanks for joining us here on Market Call. I'm Morella Fernandez. Brianne Gardner is on the show with us today. She's Senior Wealth Manager, Velocity Investment Partners, Raymond James, and she will take your questions today on Canadian and U.S. large caps. Here's how to reach us. 1-855-326-6266 if you're calling in. You can also email your questions to marketcall@bnnbloomberg.ca. Brianne, good to see you. Thanks for joining us today. Are you seeing any market reaction to the ongoing Israel-Iran conflict today?
Yeah, thanks for having me, as always, Morella. I think we're seeing both sides of the market, trying or holding a little bit steady. I think, navigating a little bit of this short-term geopolitical shock and some longer-term policy shifts. We did see a surge in oil really due to the escalations that we've seen and the tensions in the Middle East and some concerns over supply disruptions. But to us, this is no longer just about energy. It's really potentially becoming a broader supply chain issue. So for us, we're watching, rising insurance premiums for global shipping, early warnings from really industrials suggest that freight and input costs could climb again. So just as logistics had begun to really normalize in the U.S., we are watching things closely as the U.S. equities have kind of rebounded, obviously meaningfully since that April pullback that we saw. Really now the S&P and the NASDAQ up roughly 2 to 3% year to date. And we're seeing a lot of, economic data supporting that with cooling inflation, resilient consumer spending, and really the earnings that we've been getting. So I think analysts are still projecting earnings growth of 9% this year and over 13% for the next one. So that momentum behind the U.S. stock market and really even with the passage of the big beautiful bill, we are seeing that sweeping fiscal package that will continue to flow into the economy as well.
What about the TSX? We had some record highs again last week. Do you see momentum carrying on for the TSX?
Yeah, I think in Canada, the TSX continues to outperform, as you mentioned, lifted by really that strength in gold and the materials sector, industrials, and more recently, energy. I think the index, hitting all-time highs, there is a little bit cautious that we're watching, especially with, again, the global trade tensions and rising cost pressures. So we are kind of watching the margin compressions, especially in the resource and manufacturing names. But Bank of Canada has paused and continues to pause on their rate cuts, even despite some of this domestic disinflation. So I think they are being a little bit tactical on, waiting to see how much more cuts they need to make, because the market is still pricing in more rate cuts for Canada, but I think they are being pushed later on through the year. So there is still some kind of cross currents happening and potential global risks. So right now, we are positioned a little bit more balanced from that. There is a lot of noise right now in the markets, even coming off of that strong rebound we have seen. But I do think it is important for investors to remember that the stock market and the economy can move in different directions, right? And we have seen that in the past, 2020, 2022, for example, the most recent ones, where the market can continue to go higher, even if we are getting weaker data. So for us, we are making sure we are keeping that exposure to secular growth themes like AI. We don't think that's going anywhere. Also pairing with some quality defensives in energy and healthcare. So again, we think there is still some more room to run, but are a little bit cautious, optimistic for some volatility.
Got it. Okay, we are going to take a quick break. We'll line up the phone calls and emails for Brianne Gardner, Velocity Investment Partners, Raymond James. She's taking your questions today on Canadian and American large caps. Back in a moment. Welcome back to Market Call. We have Shelley, who has emailed a question in. She says, hi, Brianne. What are your thoughts going forward on Paramount Resources, which is energy, oil, and natural gas out of Western Canada? Brianne, what are your thoughts on Paramount?
Yeah, Paramount Resources. Let me just pull this one up. POU, I believe, is the ticker.
That's right.
For us, that looks like, I mean, good value stock. It ranks a 10 out of 10. Fundamentally, a Canadian energy company. Again, you have seen a nice little spike up in the stock price. I think as we've seen, again, energy doing well and seeing this little recovery with all the political uncertainty. The company does explore and develop both conventional and unconventional petroleum and natural gas. Looking, deeper into it, I think for us, not a stock that we do own, but price target upside from here. You're seeing analysts about 5%. You're seeing a little bit of mix of buy, hold, and sell. Latest earnings, they did actually outperform on the last quarter and did have a beat there, which is good to see. Dividend yield of about 2.7. It's a little too volatile of a stock for us to own in the portfolio. If you are looking to be a little bit more on the stock space, I would say you could trade this stock or again look for an entry point, but from an upside I would be looking at kind of trimming it back and waiting for a little bit more favorable price target there.
Got it. Okay, let's go to the phone lines. John has a question. He's in London, Ontario. Hi, John.
Hi, Marella. Hello, Brianne. Brianne, I've been working on a makeshift model for response to geopolitical or oil price shocks. I have determined, based on a small amount of data, that obviously resource stocks do well when oil prices go up, and they don't do so well when the prices come down. You can see it Friday and today. If there's a geopolitical shock, it seems that security stocks and defense stocks go up, oil prices go up as well. But when the crisis abates, the oil prices come down, but security stocks still go up. What do you think of Axon and Palantir? I own both. You can pick one. You probably know both. Thanks very much for your opinion.
Okay, thank you for the question.
Yeah, I mean, we look at obviously how stocks perform in all different types of events, looking at shock events. And even, I mean, if we go back through every major geopolitical shock going back to the 1940s to today, the average return 12 months later is still up about 7.5%. And the market was higher 65% of the time. I think you'll see a mix depending on what the circumstance was, if it was a war, if it was a attack, a bombing, terrorist attack, et cetera, missile crisis, Brexit, every situation is certainly different. So I do think it does depend on the location. Obviously being in the Middle East, energy is going to be a sector that is going to be impacted. From looking at Planter was the stock?
Palantir.
Palantir, sorry. Yeah, so they build PLTR, I believe is the ticker, build powerful data platforms used by government, commercial clients, really to turn complex data into decisions. So think of more AI-powered intelligence. So for us, we see their commercial business accelerating 27% growth year over year, which is great. And also their revenue jumping 40% year over year. So that's showing us strong production that a market fit. And I do think government demand remains steady, which is positive. And a long-term contracts with predictability, again, is in a more otherwise volatile tech space, I think is good. Margins are expanding meaningfully, 36%. And it trades a little bit out of premium. You're seeing 60 times earnings. So for us, I would say, again, not a stock that we do own. Right now, you're seeing the target is actually a downside of about 25%. So again, not one that we do own in our model, although I am impressed by really their AI dominance. It's a little bit skeptical on kind of the sky high valuation that we are seeing. And we have actually seen insiders selling to us that is remaining a little bit cautious on that.
Okay, so 60 times earnings, 60.
Correct.
Wow. Okay. So there's a lot of room there. Okay, let's go back to the phone lines. Moaz is on the line from Vancouver with his question. Hi, Moaz.
Hi, good morning. Thank you for taking my call. My question is on AMD. It reached a new high today. So is this now price for perfection? Is this a buy? Certainly not a buy, but sell or hold? Please advise. Thank you.
Okay, thank you for the question. We'll pull up advanced micro devices at 127.35. So it's up significantly today, almost 10%, 9.7%, or $11, Brianne. It's doing well.
Yeah. So again, not one that I own currently, have owned it in the past, have traded it as well, but not in our model portfolio. Again, I'm excited about its AI push too. And I am a little bit cautious too on that stock. So sector and positioning, I think, semiconductors are kind of the AI backbone and AMD's leader in kind of GPU and CPU. So again, trailing NVIDIA though, but still carving more of a niche with cost-effective AI chips and data center strength. So their recent performance, we've seen 6 months, I believe, up, 5%, 120 to that 127 you mentioned. So again, lagging some other semiconductors there, but I do, ranks at 8 out of 10 fundamentally. And if I'm looking at, even valuations, price target from here, we're seeing analysts about 12, 13% upside. So you're still seeing, a mix between buy and hold on the street. You're not going to get, a dividend yield for holding this stock. You are really buying it for the growth and the upside potential. So even, over looking at a 5-year chart of this stock has been, quite volatile. But I do think that there is still room to run in this industry. And I do think that we could continue to see momentum behind it. So I would be cautious on the run up. I think, even if we're looking at the performance, it's still underperforming the S&P 500 over the 1 year. So we have seen a little bit of turnaround since that April. So again, if you own this stock already, I would continue to hold it, but trimming up along the way as well.
Got it. Okay, Brianne, we are going to take a quick break. We're going to line up some more phone calls and emails for Brianne Gardner of Velocity Investment Partners, Raymond James. We're back in a moment. Welcome back to Market Call, and thanks for joining us today. We have Brianne Gardner with us. We're going to get to an email right now. Brian has written in, he says, what does Brianne think of CNR for a long-term 5+ years hold? Canadian National Railway. Do you guys invest in railways? Have you done that in the past?
Yeah, I mean, we have, and we still like the rails. I think there's a lot of development that happened. Obviously, CNR, still spans from Canada coast to coast and now into kind of obviously through Chicago and the Gulf of Mexico. I think, 1 year, you're seeing really flat in the rails, especially CNR. Fundamentally, we still think there's upside, but I do think that it ranks a 9 out of 10 for us, but from a value score, it's a little bit weaker. You're seeing about a 6 out of 10. So for me, I would like to see a little bit more of a juicier stock, mixed signals across the street between kind of buy, hold, and outperform, in the middle of the pack of kind of hold, looking at about 11% upside. Last quarter they did beat their earnings per share estimate, but missed the quarter before. So again, we would like to see a little bit more consistency there. If you are holding this stock for the long run, 5-year return, what we've seen has been underperforming and kind of a little bit on a downtrend, almost since April of 2024, so about a year ago. Again, for me, I would wait to see a turnaround before adding this stock, and try and get that. You're still getting, 2.5% dividend yield, nothing really to write home about. So I would like to see a little bit more momentum from the rails before getting in. Any idea,
as you mentioned, it's been on this steady downturn from last year early on. Any idea of what could have triggered that? We would have expected that at the start of this year with the concern of tariffs and perhaps not as many rail cars going across the border or even across Canada. But any reason why it would trend that way since last year?
Yeah, we have seen CNR investing quite a bit into, into other states as well, right? I think they were doing Illinois, Indiana, Tennessee, et cetera. So they have been making investments, and usually when you do see big spends like that as well, you can see the stock price get hit. So yes, they are investing for the future, but they are using a lot of their capital to do this. I mean, we're seeing like 20 million, 30 million, 170 million, 50 million, US 85 million, right? So these big investments, we have seen them kind of impact the stock price. Do I think that, CNR isn't a great stock over the long run? No. And I think that they will turn around. I think we have seen, again, some supply issues, and I think we will continue to see some of that. But and now, especially with kind of this trade war tariff implications, it would be interesting to see how the rails are, right? Can we expand into other partners? What is their long-term plan that they are looking to do there? Again, not a stock that we do own. I would wait to see a little bit more of a momentum change in the stock before getting in.
Got it. All right. Let's move on to Derek, who's holding on the line from Chilliwack. Hi, Derek.
Oh, hi. Great show. I just have a question regarding Premium Brand Holdings. I noticed that the stock has not really done too much, but they just reported their latest quarter and they had record earnings. So I'm just wondering if this is a stock that you would look at, and I value your opinion. Thanks, Brianne.
Okay, thank you for the question. Food processing company, Premium Brand. Do you know much about Premium Brands, Brianne?
Yeah, again, I have owned it in the past. We don't own it currently. For us, I mean, yes, as you mentioned, right? Food manufacturing, premium food distribution, wholesale business. You're kind of seeing across Canada there, a little into the States as well. And for us, I mean, looking at the stock price there, you're seeing a good value. Hasn't really done much over the last 5 years, and kind of, underperforming, even if we are looking at the TSX 60 there. I mean, year to date, you're watching the stock and has slightly positive territory, up 1.8. You're still getting a decent dividend yield of about 4.3%. But I mean, the wholesale business isn't going anywhere, and we think that there is still upside in that space. I think, again, if we are seeing worse economic data, that could be something that we would be paying attention to. But they are still, remaining strong. Their first quarter earnings revenue beat expectations. Their earnings per share lagged a bit, though. So again, cautious there. And I think, for us, it's, again, not a stock that we own in our portfolio.
Okay. We hope that helps you out. Let's move on to Daniel, who's calling today from Markham, Ontario. Hi, Daniel.
Hi, Marilla. Hi, Brianne. Great host and great guest.
Thank you very much.
My question is on Constellation Software. Is this a company you're interested in? At what price would you start a position, and your overall rating? Thank you for taking my call.
Yeah, Constellation Software, $48.50 today, up $20. So doing really well, a bit of a run today. Brianne, have you guys invested in Constellation before?
Yes, we have. And I mean, I think the stock I actually really like the stock. And I think that they have done a good job at, acquiring, managing, and continuing to grow. I think vertical market, we've seen in the software companies, they buy small niche businesses and hold them really forever. I think what makes them unique or different is their discipline. I think they've stuck to a playbook, of really that decentralized management and capital efficiency, and it works for them. I think they've done a good job. I think organic growth has picked up lately, which we're starting to see, which for us is a nice bonus on top of kind of their steady M&A that they've already done. Their free cash flow is strong. Returns on capital are among almost the best in the market. So for us, they do know how to put every dollar to work. Yes, the stock rarely looks cheap, but it does have, a proven compounder with really decades of runway we see, especially as they expand outside North America. So fundamentally, it ranks a 9 out of 10 for us, and a stock that I do like.
Got it. Okay, we are going to take another quick break. When we come back, we'll go through Brianne's past picks. We're back in a moment. Welcome back. Brianne Gardner is with us today. We're going to go through past picks from July 17th, 2024, so less than a year ago. At the time, Brianne, you picked Visa, and it was 272.70 American. It is up to 358.47 today. So a 31% upside here, a 32% upside. Is this a company you will continue to hold?
Yes, we still hold Visa. I still like Visa. We're still bullish on Visa, so we still maintain that, at least right now. I still think Visa holds a dominant position in really global payments, even alongside MasterCard, as most people know. And I think their track record, has had consistent execution. It has beaten revenue and earnings per share estimate for 8 straight quarters, despite macro headlines and gains from growing transaction volume. Especially taking on credit risk. So for us now, over 25% of revenue is led by value-added services. So their fraud prevention data. Stocks up 30, as you mentioned, over 30% since our recommendation, and currently trades a little bit about a premium. We saw a 5% drop on Friday on the stable coin concerns, but long term, we still think there's upside to go. So we think about 10%.
Got it. Okay, let's get to your next past pick, which was United Health. At the time you recommended it, it was 573.28 American. It is down to 308.76, so a downside of 46%, 45% total return drop. A lot has been happening in the States with healthcare and trying to cut costs, and United Health itself has had some challenges over the last year. So did you stay in this stock since last July?
So we actually doubled down on our position there. And we just felt, we saw this sell-off. There was a lot of, as you mentioned, headlines around the CEO, ongoing investigations, have kind of introduced governance concerns and headline risk. So we did a deep due diligence on this stock and decided if we wanted to cut our losses or double down. We saw upside and thought the stock was extremely oversold, and they had been through an investigation like that before. Still one of the most integrated names in the U.S. healthcare, insurance, pharmacy, care delivery. So we don't think that they're going anywhere. We are going to be a little bit more active in this stock, though. They're still targeting 13 to 16% long-term earnings per share growth. We averaged down and bought at 273 in May, brought our cost base back down to that 402. So, 423 is average based on our July 17th start price. Again, today where we're sitting, plus our dividends, reducing our loss on the stock to about 20%. So we still continue to see United Health as a high quality compounder in the near term noise, but long-term tailwinds.
Okay, so you would advise people to bite back in at this point. Still, you bought at 273. Obviously, it's gone up since then, but should people still buy in at this point?
Yeah, I mean, for us, we still see upside from here, and I think that is important for us. So we are continuing to hold our position and will trim back. Again, I think this is a tactical, not a buy and hold stock. There is a lot of headline noise, and it is making that stock move. So for us, we're continuing to hold. If you are looking to average down, still not a bad time. You're still well below that July price. But yeah, for us, we're holding and maintaining that double down.
Got it. Okay, let's go to your third past pick from July last year, Lululemon. Now, at the time, it was 292.68 American. It has dropped to 239.84, an 18% return and total return drop. They have seen slowing sales in some of their markets, and they are sort of in the middle of tariff concerns as well. What are you doing with Lululemon?
Yeah, so we actually no longer own Lululemon. It is a name we followed closely for years. And I think at that time, the stock was extremely sold off. It was just on a downward trend. And we were like, we haven't seen prices like this for a while in Lulu. So we picked it up and actually sold it on December. So it wasn't a long hold for us. We sold it at just over 401.80 on December 6th. So total return for us was about 36-37%. And sometimes I think that's what you need to know too, right? Is like, we are active managers. We're not going to, always hold on to a position forever. If we think there's more upside to run, we will, but we also aren't greedy. And when we can get a 35% return, we will take it and take those profits off the table for clients. So, valuation has reset and has created an opportunity, especially after rallying hard into the last part. The stock has pulled back sharply, seems to be a little bit now oversold, even with the recent guidance cut. Again, with recession fears slowly starting to fade, you could acknowledge that there could be some upside, but we are super underweight the consumer discretionary space. We think there's still a lot of risks in that sector.
Got it. Okay, Brianne, we are going to take another break. We'll line up some more phone calls. We're back in a moment. Welcome back. Thanks for joining us on Market Call. Brianne Gardner is our guest today. Let's go back to the phone line. Nazar is calling from Scarborough, Ontario. Hi, Nazar.
Oh, hi, Marilla. Hi, Brian. May I have your thoughts on freehold royalties, please? This stock has been range-bound for a long time in the $12, $13. It has a good dividend yield. Is the dividend safe? My recollection is you held this stock. Do you still hold it? Thanks for taking my call.
Okay, so Brianne, freehold royalties.
Yeah, freehold royalties, again, is kind of in the acquiring and managing the oil and gas royalties. So I do like that. I think it's a little bit less risk on the energy space. I think they operate kind of the two segments, Canada, which includes the exploration, and then the natural gas as well. Value, it's still a 10 out of 10 for us, and fundamentally an 8 out of 10. It is a stock that we do continue to hold in the portfolio. And as you mentioned, still getting a healthy dividend. The forward dividend yield, you're looking at about over 8%. Do I think there's any risk? Price target upside, you're still looking at about 19% from here. I don't see a risk to the dividend at this point. So for us, again, we continue to own the stock. You're up about 5.5% year to date. And we still think there's more room to run.
Okay, thank you for that. Let's go to Manfred from Millet, Alberta. Hi, Manfred.
Hi, thank you for taking my call, and you're my favorite host.
Thank you very much.
I own Air Canada shares, and I got a notice as voluntary Dutch purchase offer. I don't quite understand it. It says they're offering between $18.50 and $21 a share. But do I take it, or what do I do with it?
Okay, so we'll have a look at the line chart here. They're at $18.80. Air Canada has been sort of on that downward spiral for a while now. They're buying back shares. Brianne, if you were Manfred, what would you do here?
Yeah, I think there's been a lot of noise around the airlines as of late. I think airlines are a little bit of a tough game. High cost, cyclical demand, thin margins. Air Canada is still one of Canada's top carriers, I think, and has that global network, but still battling a lot of U.S. giants like Delta, for example. As you mentioned, Marilla, recent share buybacks do offer kind of lifted shares, so something that we are watching. We have seen, cost cutting. They were $150 million projected in 2025 that could boost their free cash flow for the stock. They do carry quite a bit of debt, though, in their stock price. And again, tariffs, I think we see that as a risk related to vacationing, especially, that could impact the stock, at least on the short term, and hike kind of those some of those additional costs there. So that would mean less travel on U.S. routes, slashing revenue, and we are hearing that from some clients as well. There's still price target upside of about 30% from here. So I would be a little bit cautious with Air Canada. I can see a value play in the stock. It is not a stock that I own, and I wouldn't be buying it right now until I got confirmation of a turnaround. And again, weakening economic data. What do people cut first? It's going to be at that consumer discretionary spending like travel. So for me, I'd stay away from it right now.
Got it. Do you think he should sell if he has that offer to sell in front of him from Air Canada, or is it worthwhile holding until things sort of improve from travel?
If I currently own the stock, I would be holding.
Okay. Good to know. All right, let's go back to the phone lines. Brian is on the line from Ottawa. Hi, Brian.
Hi. My question today is on Pembina pipelines. While some of the others, like Enbridge and TC, are much closer to their 52-week highs, Pembina is give or take 15% off, and it seems to have been struggling for a while at this price level. I'm wondering if you're aware of any particular reason why it's been struggling, or have an opinion about that as well. What do you guys have as a value for this stock and price target? Thanks.
Okay, thank you for the question. Why has Pembina not sort of been moving up the way some of its peers have?
Yeah, Pembina is a stock that, again, we do own it and it is in our portfolio. And I like its steady dividends for me. I think that, they are also renewed their share buyback program as of recently. Earnings per share seem to be promising, is increasing its dividend. So, for me, that is showing a lot of positive signs. I think even the energy pipelines, yes, are cash flow machines, and Pembina's, a Canadian leader. So we still like it. I still own it. I think, they're doing 2.9 million barrels a day at capacity, neck and neck really with Enbridge. And I just don't think that the stock has gotten the price that it deserves. I do think, upside, we're still seeing that $4 billion project pipeline that could boost 15% earnings per share growth in 2025, and I don't think that that's been fully recognized into the stock. So you're still getting about 5.5% yield and strong cash flow. Yes, I think a challenge is their payout ratio limits reinvestments. They have about 90% payout ratio, reinvestments over the next 6 to 12 months. But again, is a stock that I own, and I think that we are continuing to hold it. We see it at about a 9 out of 10 at a value, and fundamentally an 8 out of 10.
Got it. Okay, Brian, I hope that helps you out. We're going to move on to Michael, who's calling from Miami today. Hi, Michael.
Yes, good morning or good afternoon. Do you have any opinion on the medical stock like Pfizer or Merck or something like this? I have a lot of Pfizer, and mainly for the dividend. Do you feel the dividend stays safe for the future also, and the growth for 3-5 years?
Okay, thank you for the question. So a lot of the healthcare pharma stocks have been lagging quite a bit, Brianne, and I'm wondering why. If there a reason for that, was it a trigger for that? I mean, tech is all the rage and people just aren't investing in healthcare as much?
Yeah, I think you get a little bit of mixed signals. Healthcare significantly can be leaned as more of a defensive name. And I think you have started seeing a little bit of a rally up in healthcare lately, in the last few weeks. For us, we actually like the healthcare space. I think earnings per share growth, healthcare sector for the S&P 500 was expected to do anywhere between 18 to 20%. And I don't think we've seen that. So for me, that's showing us the healthcare sector could see a boost the second half of this year. For Pfizer, I don't own Pfizer in our model. So again, it's a little bit of a lower valuation is tempting, but I do think there is some uncertainty, cost-cutting risk that make me prefer, I think, our healthcare picks. I hold Abbott, AbbVie, Merck, UNH we talked about earlier, and Eli. So I do think, again, pharma is a defensive powerhouse and Pfizer's a global leader known for their vaccine and oncology. But I think, trailing, for example, Eli Lilly's innovation edge is really in that crowded field. So it is a little bit crowded out of the U.S. Upside, their oncology drugs still could drive 5% growth. I think they do have some challenges on the slowdown of some vaccines that could hurt their revenue, and pipeline delays could kind of lag some of these rivals as well. So for us, it's a hold, cheap, but for me, uninspiring, and I prefer to go elsewhere.
Got it. Okay, we are going to take a break. Brianne Gardner's our guest. She's Velocity Investment Partners Raymond James, taking your questions on Canadian and American large caps. Here's how to reach us. We're back in a moment. Welcome back to Market Call. Let's go right to the phone lines. David's on the line today from Edmonton. He's got a question for Brianne Gardner, who's our guest today. David, what's your question?
Hello, and thank you for taking my call. I'm calling regarding Royal Bank specifically. What your thoughts are as far as a short-term hold? So for the next 3 to 6 months, is it safe? Do you see any upside, downside risk specifically, or would you suggest a different bank instead of Royal?
Okay, thank you for the question, David. Brianne, most people want to hold the banks for long terms because they've got good dividends. But if you don't want to hold it shorter term, is this what you would do?
Yeah, I mean, I would agree with you there, Marella. I mean, most Canadians, too, do own the Canadian banks for the long term. I think with Royal, it is one that we do own. For us, it ranks at 8 out of 10. I think they did miss last quarter's earnings, really largely due to higher provisions for credit losses, which we did kind of expect. But we actually see that as kind of more prudent risk management in a more cautious economic environment, not really a sign of structural weakness. So the core business is still performing well. Revenue is up 11% year over year with really good momentum. And we saw their net income, interest income, and lending activity go up. So for us, I mean, we like the stock here. Short term, yes, I think you could see some volatility that may persist due to economic headwinds in Canada. But so you could be a little bit patient. I mean, you have seen a run up since that April. So from a valuation perspective, if you are looking for an entry point, you're only seeing about 4.5% upside from here. I would be a little bit patient, wait for some short-term volatility, and then either get into your position or add. If you are looking for longer term, as you mentioned, Marella, we continue to hold it and making sure we are being active and trimming it back as well. But I believe Royal is still well positioned to deliver long-term returns in any rate environment.
Got it. Okay, let's go back to the phone lines. Carthy on the line from Toronto. Hi, Carthy.
Hi, thanks for taking my call. This is my first call to yours.
Welcome.
I have a question about Chevron. It was up and now it's at 140 level. It hasn't recovered that much after the April slump. So is it a good buy? I mean, I see it's giving good dividends as well. So I'd like to see what's your take on it.
Okay, thank you for the question and thanks for the call. It hasn't recovered. It's still hovering around $145 after that dramatic slide. And that's even though we've seen some of the energy stocks come back. Brianne, what's your take on Chevron?
Yeah, Chevron isn't a stock that I own. I do, and we watch it very closely. Has been a stock that I think we've been following for a while. You're still getting, a healthy dividend yield, about 4.6, 4.7%. Yes, it, is extremely volatile from that perspective. But even if I'm looking at it fundamentally, Chevron is still quite strong. I think they're best really positioned U.S. energy majors and is one of the best. I think they have a strong balance sheet, diverse really portfolio that spans from oil, gas, LNG, really all essentials that you need in that energy mix. I think they are disciplined in their capital spending. And I do see upside. I think their free cash flow does remain robust. Their free cash flow yields approximately near that 9%, which does continue to support its dividends. So I don't see any issues there, and share buybacks, even on a lower commodity price environment. So yes, it is still pending that Hess acquisition as a strategic move to gain exposure, but to one of the fastest growing offshore basins. But for us, again, the stock has lagged peers recently due, I believe, to M&A related overhang and kind of softer oil prices. So we do think it's set up for a compelling entry point for Chevron.
Got it. Okay, let's get to one last caller before we have to take a break. Nicole's on the line from Montreal today. Hi, Nicole.
Well, ladies, you just made my day and you kept the best for last. Apple going forward. Thank you.
Thanks,
Have a
Nicole.
good one. Thanks.
So let's take a look at Apple. A lot of headwinds here with what's going on in Washington and tariffs on exports from China, which affects Apple. That's where they make a lot of their phones. Plus, there's a lot of legal suits against them for certain things that they may have monopolies on. So I'm just wondering, in the tech space, if you still like Apple?
Yeah, so thanks for the question. And yes, Apple is a stock that, as you mentioned, there is a lot of noise around the stock right now. We don't see it as, one of the leaders necessarily. I think it is starting to pivot. I mean, we actually just were talking about this stock last week with our investment committee. Still, the company is so big, right? I mean, they're one of the largest companies in the world. I think from a value perspective, though, they've had a lot of run over the last few years. And, the innovation that we used to see from Apple, I don't know if we're still getting that. So for me, it is we're seeing about a 3 out of 10 from a value. Fundamentally, the company is still strong. I think it will still continue to do well over the long run. But are you going to see those same returns that we got from Apple in the past? I don't think so. I think you're seeing analysts on the street, a little bit of mixed, this tug of war between buy those Apple people and then also the hold that people are starting to see. And now you're starting to see some sells on the street. So yes, people are still pricing in about 15% upside from here. But how long will it take us to get to that 15%? I do think is important. We do still own it again in our model, long-term core portfolio. We have trimmed occasionally. I love the ecosystem that they do, but we are looking at potentially trimming again. I think just waiting for a rally to that 210, 220. It has been disappointing though. And again, I think they have been a little bit of a miss and lagging on to all rivals, quite frankly. And Apple has kind of, I believe, the worst AI in the space right now. So they really need to turn it around and something needs to change. That said, they're huge money-making machines. Just worried about the growth might not be a leader. So I think, again, tariffs are priced into it now, I believe, in this pullback. So most bad news might be priced in.
Got it. Okay, we have to leave the phone calls and the emails at that. But when we come back, we will share Brianne's new top picks. We're back in a moment. Well, welcome back. Time now to take a look at Brianne's new top picks. Her first one is ATS Core, which does automation for, I guess, manufacturing. Brianne, can you explain a little bit more about what they do and what you like about them?
Yeah, so we're in kind of the industrial space, as you mentioned, Canadian leader in really custom automation systems for large scale manufacturing. So they do support kind of vaccine production, nuclear energy, and food processing. They have a strong momentum, over 850 million in bookings last quarter. They did have a bit of a backlog that hit a record of over 2 billion. So for us, that does offer a clear revenue visibility of what we can expect going forward. I think the company is refocusing on high value sectors after exiting a troubled EV contract. So their margins are recovering, signaling to us improved operational execution. Their balance sheet's flexibility has allowed them to renew M&A activity. Again, we think the industrial sector is supposed to see about 18% earnings per share growth for 2025. So why we like this sector as a whole. And I think falling interest rates, global stimulus, can boost, infrastructure and manufacturing. So for us, we see about 22% upside in this stock, and it ranks about 8 out of 10 for us.
Got it. Okay, let's get to your next topic, which is Altius Minerals on the TSX ALS. And this is a company that's in mining, but not in mining. They get royalties?
Yes, exactly. And I know we touched briefly on another royalties companies there. But for us, yes, Altius Minerals is a royalty company earning revenue from mining without actually operating mines. So they're not taking on that risk. We like royalty models for really their high margins, their scalability, and their compounding potential. So Altius is well exposed to structural growth sectors like copper, potash, renewables. And I really see it as its mix supports that steady cash flow and upside from global trade trends in sustainability and electrification. So financials are solid, low net debt, generates strong operating cash flow. And I still like the sector. I mean, you've seen a run up, and I think falling interest rates, global stimulus, all of that good. Weaker US dollar will continue to push up that sector. So we have about 24% upside from here and ranks a 9 out of 10 fundamentally for us.
And you see a price, or you have a price target of 33 and change?
Yes, exactly. Our price target's about 33.70, which is where we're getting that upside potential. I mean, the stock returns over the last, 1 month, 3 months, 6 months, and 12 months. The stock's done about 26% year to date, only about 2.8. So again, we still see some room to run at all-time highs, still off the peaks of about 11%.
Got it. Okay, let's go to your last top pick, a well-known name, Salesforce. And it's a company on the New York Stock Exchange is where you like it. Tell me why Salesforce as far as growth here.
Yeah, I mean, Salesforce, big name, most people know, global leader in really that CRM software and kind of the pioneer in the SaaS model. I think they're really evolving into the operating systems for more modern enterprises, far beyond just CRM anymore. They're doing the data cloud, Agentforce, AI-powered insights, and I think that is gaining traction for them. They've done $1 billion plus in reoccurring revenue, and a big part of their top deals now includes AI. To me, I think their valuation is still appealing, trading at 22 times forward earnings, so near the low end of its historic range. And again, they're continuing to scale, so they're boosting shareholder returns through buybacks and dividend. For us, we see a potential upside of about 36%, looking at a price target about $3.52 per share. Ranks a 9 out of 10 for us, and still the stock's down about 23% year to date. So again, this is a stock that I think has great value.
All right, Brianne, I do have to leave it there because we're out of time, but Brianne Gardner has been our guest today. Thanks very much for joining us, and thank you for joining us on Market Call. We'll see you again tomorrow.